Hello everyone and welcome back to my video blog. Today I'm going to share my computer screen with you and a spreadsheet that I have worked with several of my buyers recently who are concerned about the cash flow, especially in this current high interest rate, 7.5%, double of what more than double what we had before 2 years ago. Okay, so I want to give them some relief that actually the cash flow is great. It's it's not like after buying a home you have to scrimp on either a vacation or a night of dinner out or some of the niceties. Okay, so bear with me. I'm going to show you based on an average price in Los Angeles County, 20% down. You can get 3% down as long as you have a 680 FICO score and above. Fannie and Freddie have those programs available for you. Okay, or FHA is 3.5% down. If you don't have the FICO score, 620, you can get a loan 620. For anything lower than that, you might have to increase a little bit your down payment. So 3.5%, 620. Is the norm for FHA loan, right? So I'm going to share with you standard 20% down based on the average home price in Los Angeles County currently, which is at $833,000. Okay, and you see the effect of having been able to deduct your loan interest, your mortgage interest, as well as property tax, and actually you have some cash flow you have never expected. Okay, so follow me on this one as I'm sharing my computer screen with you. Okay, so this is a loan amount. As you can see, is based on 80% loan to value on an average price of $833,000. Okay, in the Los Angeles County, amortized over 30 years at 7.5% interest. Okay, so the monthly mortgage payment is $4,659. Okay, plus $833 for the property tax, $150 for the insurance. That's your monthly payment right here. Okay, $5,600. To qualify for this one, a couple need to have about $13,000 in income. So that $13,000 income, I also include already $600 in either student loan or a car payment, okay, or some credit card payment obligation. Okay, so if you don't have this kind of thing, you will need less. So what is $13,000? It's $156,000 a year, roughly about 76, 73, $78,000, right? Okay, per couple, per person on the couple, right? Okay, so it's not out of the ordinary. Now that this kind of wages can afford you to have a home in LA County. So affordability is still there, right? Okay, so what do you have on the state tax level is 9.3% based on this income, married, filed jointly. Okay, $1,200. And then for the federal tax bracket, 2,800. So you have a total of that monthly tax is $4,000. Okay, so look at when you have your mortgage interest deducted. So your mortgage interest for the year is $49,000. Okay, the property tax about $10,000. So for a $60,000 total of deduction. Okay, so you have more deduction, your CPA can find some more deduction for you. However, I want to simplify this one just based on two basic deduction that you can obtain as a homeowner. Okay, so on this case, what you have? You have $156,000 minus $60,000. So your effective taxable rate is $95,000, right? Okay, so what transfer to on your tax liability? So your tax bracket for state of California, we drop from 9.3% to 6%. So 6% on 95,000 will be 479,000, and your tax bracket on the federal is still 22%. However, your effective tax rate will be $1,700. So the difference between not owning a home and being a homeowner, you have an additional $1,800 of tax deduction, so which is increase on your cash flow. So how you do that? Before you wait for April, May, June file tax return, so the IRS and Sacramento give you back the refund, which you are giving your money interest free to the federal government as well to the state coffers. What you have is to go to your payroll department, to your HR, and ask them to give you a new W-4. Okay, so you increase the number of dependent. They have calculated for you. So watch something like that, so you can decrease your tax deduction on each your paycheck down $1,800. Okay, so you won't owe any taxes, and you don't have to wait for the refund. Okay, so effectively your $5,600 PITI mortgage tax insurance payment, after the additional deduction that you have for the month of cash flow, so actually you have $3,800 effectively. Okay, so it's pretty much like you're renting a home right now, a 3-bedroom home right now. You have to rent it between $3,500 to $4,000, isn't it? So that's what you see on your cash flow. So you don't have to crimp on your vacation. You don't have to, all the niceties is a night out once a month or once a week, for have a dinner, okay, on the town. So just bring, the number that you can work out with your CPA, your accountant, your bookkeeper, to the W-4 with the payroll department. Have to increase our number dependent you claim on the W-4, and you have increase in cash flow. So that give you relief, then that you, after buying a home, you're not crimping at anything else that you used to. Okay, a night out, a vacation, something like that. Okay, so I welcome your feedback and your comments, and until next time, stay safe, stay healthy.